Hello students, welcome to BYJU'S IAS. Welcome to a session on economy this week, wherein we'll be taking up some of the very important articles that have appeared in various business related newspapers, and we'll be analyzing these particular articles. For this particular video, I've chosen the time period from 30th of September to 13th October 2019, and the articles that I've chosen are from Business Line, Hindu, Business Standard, Indian Express and Limit. Let's begin the discussion. The first article is on deposit insurance. With the debacle of Punjab and Maharashtra Cooperative Bank, this particular concept of a deposit insurance has come into the limelight again. In the last 1 year, there has also been a discussion on the deposit insurance because Government of India had introduced a bill by the name of Financial Resolution and Deposit Insurance Bill. But because of various issues with respect to the provisions in the FRDI bill, Government of India had to withdraw this particular bill. Right now I'm mentioning this, Government of India very recently has stated that they are going to reintroduce this particular FRDI bill. Now what is the importance of FRDI bill? Please understand, in case of Indian economy, right now with respect to insolvency resolution, for corporates, for retail borrowers, we have got insolvency and bankruptcy code. Now what about the insolvency resolution of a financial institution such as bank? It is handled by RBI. In case of a mutual fund company, there's a different authority. In case of a pension company, it's a different authority. In case of an insurance company, there's a different authority. All I'm trying to say is, in terms of having insolvency resolution for financial institutions, there is a fragmented framework. To overcome this particular issue of having a fragmented framework, Government of India had proposed a financial resolution and deposit insurance. So, for insolvency resolution of a companies as well as retail borrowers, there is insolvency and bankruptcy code. For having financial resolution of financial institutions, Government of India had proposed FRDI, Financial Resolution and Deposit Insurance. In this particular Financial Resolution and Deposit Insurance Bill, Government of India had highlighted the concept of a deposit insurance. Now what is this idea of a deposit insurance? The deposits that we keep with the banks will be provided with certain insurance. I'm using the term certain insurance for a simple reason. Let's say hypothetically, there is a depository X who makes a contribution or keeps a deposit of let's say 50,000 rupees with a scheduled commercial bank. There is another depositor Y who keeps let's say 1 lakh rupees of a deposit with Urban Cooperative Bank. And there is another depositor Z who keeps let's say 10 lakh rupees with NBFC, non-banking financial company. Now if all the three banks or financial institutions file for bankruptcy, how much of these particular deposits will be covered with insurance? Or these particular depositors, will they get anything in return from these particular companies? In case of India, understand this, deposits up to 1 lakh rupees, I'll repeat the statement, deposits up to 1 lakh rupees are provided with insurance by Deposit Insurance Credit Guarantee Corporation. Deposit Insurance Credit Guarantee Corporation. Government of India passed an act. As a result of this particular corporation was set up. And this particular corporation is a subsidiary of RBI, that is in simple terms functions under RBI, collects a certain insurance premium from the banks and provides insurance to these particular deposits. Now what type of banks are covered by Deposit Insurance Credit Guarantee Corporation? One, scheduled commercial bank, be it domestic, be it foreign, regional rural banks, urban cooperative banks, etc. NBFCs are not covered under this particular corporation, or deposit insurance is not provided by this particular corporation to the deposits held under NBFCs. And second, primary cooperative societies, even those are not covered under this particular act. So the example that I've given, in case of the first depositor X who has kept 50,000 rupees in a scheduled commercial bank, his 50,000 rupees will be insured, he will get it from this particular corporation. But the time that will be taken will be very long because the bank has to file for liquidation, a register has to be appointed, then the liquidation process has to be completed, And when the money is garnered in the liquidation process, the funds will be used to give the money of the depositors. So X will receive his 50,000 rupees because he has deposited in the scheduled commercial bank. This is covered under the Deposit Insurance Act. And since the deposit done by X is only 50,000 rupees, he will get it back. Second, Y has contributed how much? 1 lakh rupees in urban cooperative banks. Is it covered under DICGC? Yes. Will he get his amount back? Yes, but only up to 1 lakh rupees. Since he has deposited only 1 lakh, he would get the amount. Third, Z has kept 10 lakh rupees. If NBFC files for liquidation or if NBFC goes for bankruptcy, is there any guarantee of the deposits done by Z? Absolutely no. That is a basic difference between the deposit insurance in case of India. Though DICGC provides for deposit insurance, various experts have basically noted that this particular deposit insurance which is provided in case of India is very less. What do you mean by this particular amount is very less? As of now, the deposit insurance provided is how much? Up to 1 lakh rupees. This particular amount of 1 lakh rupees was fixed back in the year 1993. And post this particular 1993 revision, we have not made any changes with respect to amount of a deposit coverage. Whereas in other countries such as the Philippines, the deposit coverage is more than $9,000. In case of China, it is $70,000. In case of a country such as Thailand, the deposit insurance is around $1.6 lakh. So when compared to Asian peers, the deposit insurance that is provided in case of India is very marginal. That is, although it is 1 lakh rupees in terms of dollars, this will come somewhere in the range of $1,400 to $1,600. So that is the first point. Second point, even if I link or if I index this particular amount of 1 lakh rupees to inflation, that is between 1993 to 2019, this particular amount of 1 lakh rupees would have become more than 5 lakh rupees today. So if I index this particular amount of 1 lakh rupees to inflation, it will become more than 5 lakh rupees. Whereas the deposit insurance provided has been fixed at only 1 lakh rupees. Hence, there is a need of revising this particular deposit insurance. Second point. Third point. Majority of the households have a financial savings, and majority of these particular financial savings, the households will put in the banking sector. And since the households believe in the stability in the banking sector or believe in the safety of their deposits in the banking sector, the occurrence of these kind of incidences such as a PMC debacle have to be controlled. And one of the ways of ensuring the safety of the deposits of the depositors is by providing higher safety or higher deposit insurance. Fourth point, the number of deposits which are holding more than 1 lakh rupees has increased over a period of time. The graph is given in this particular article here, which shows what percentage of the total deposits have less than 1 lakh rupees or more than 1 lakh rupees. Now, in the year 2001-2002, 94% of the deposits had a deposit value of up to 1 lakh rupees or less than 1 lakh rupees. And 6% of the deposits had a deposit of more than 1 lakh rupees and above. But over a period of time, this particular number has increased. By 2017 and 2018, as per RBI survey, more than one third, that is around 38% of the total deposits held in the banking sector have a deposit of more than 1 lakh rupees. And since they have more than 1 lakh rupees, the insurance which is provided should also be more than 1 lakh rupees, so that the safety component of these particular deposits increases. So this is another argument which has been put forward by various experts so as to ensure that the government of India will look into it or RBI will look into it and the deposit insurance coverage will be increased over a period of time. So these are some of the points which are discussed in this particular article. Now based on this, let's have a look at questions here. Consider the following statements. DICGC is a subsidiary of SEBI. Wrong. DICGC is a subsidiary of RBI. Deposits up to 1 lakh are covered by DICGC, or in simple terms, DICGC provides insurance for deposits up to 1 lakh rupees. Yes, second statement is true. So the right option will be option B, only 2 is true. Next question, which of the following types of banks are covered under the Deposit Insurance Act of 1962? RRBs, yes, they are covered. Scheduled commercial banks, yes. Foreign banks which are operating in India, yes. Urban cooperative banks, yes, all the 4 types of banks are covered. Right option will be option D, 1, 2, 3 and 4. I've also given a descriptive question. With changing macroeconomic situation, there is a need for reviewing the deposit insurance in India. Elaborate 250 words. So these are some of the questions as well as the discussion related to deposit insurance in India. The next article is related to one of the WTO disputes. Please understand, Government of India, in order to promote more and more exports, will give certain incentives, or in simple terms, provide subsidies to promote exports. Government of India has announced a policy of a foreign trade policy which is applicable for a period of 5 years from 2015 to 2020. And very recently there has been a discussion that Government of India started working on a new foreign trade policy which will be applicable till 2025. But more importantly, focus on the foreign trade policy here. Within the foreign trade policy, Government of India has announced one very important provision or one very important reform. That announcement was related to one of the export incentive scheme by the name of MEIS, Merchandise Exports from India scheme. This particular scheme was announced by the government, which basically subsumed multiple type of subsidy schemes which were announced by the government earlier to promote merchandise exports. So rather than having multiple types of schemes or multiple types of subsidies to promote exports, under FTP 2015-2020, Government of India has subsumed these types and has announced one type of a scheme. This is called as Merchandise Exports from India scheme. Under this particular scheme, notified merchandise or notified goods, when they are exported to notified markets or countries, government would be providing certain incentives. This incentive or subsidy will be directly linked to what is the value of exports done by the exporter. Have you understand the statement here? Under Merchandise Exports from India scheme, Government of India would be providing certain incentive or subsidy if notified goods or merchandise are exported to notified markets or economies or countries. Now, Government of USA took an exception to these kind of schemes and dragged India to WTO. Now, what was the exception which was quoted by Government of USA? Government of USA basically contended that since India's gross national income per capita has crossed more than $1,000, India is basically violating Article 3 of Agreement on Safeguards and Countervailing Measures. I'll repeat the statement. Government of USA basically stated that as per Article 3 of Safeguards and Countervailing Measures or Agreements on Safeguards and Countervailing Measures, basically prohibits the governments or the countries to provide export incentives if their gross national income per capita crosses $1,000 for 3 consecutive years. In case of India, gross national income per capita crossed more than $1,000 in the year 2013, and since then it has remained more than $1,000 itself, and as per latest figures it is more than $1,900. So Government of USA basically cited this particular article, went to WTO and filed a case against some of the export incentive schemes of Government of India. They targeted Merchandise Exports from India scheme. Another very important scheme that was quoted by US government was export promotion of capital goods. Another very important scheme that was quoted by Government of USA was special economic zones. So Government of USA dragged India to WTO, filed a case against the export subsidies and said that since your GNI is more than $1,000, you are not allowed to give these kind of export subsidies. Now, one point to note here is Government of India back in the year 2015 had stated that they are going to withdraw these particular export related subsidies. And even in the year 2017, same thing was quoted by Government of India. But despite announcing it 2 times in the last couple of years, Government of India has not taken these particular reforms to withdraw them. Rather, they have continued to provide these kind of export incentive schemes. Now, Once the case was taken up by WTO, the dispute resolution body under WTO formed a dispute resolution panel consisting of 3 experts. These 3 experts took up the case, investigated what is the situation in case of India, and has submitted a report to this particular body stating that yes, India's schemes are violating Article 3 of agreements on safeguards and countervailing measures. And since this has given ruling in favor of USA, Government of India either has to withdraw these particular export related schemes or export incentive schemes, or will have to appeal against this particular order of the panel in the next 30 days. Now what will happen if Government of India decides to appeal against it? If Government of India decides to appeal against this particular order of a dispute resolution panel, then this will be taken up by appellate body under WTO dispute resolution mechanism. And the issue right now that has been in the news with respect to appellate body is, in case of the appellate body, the sanctioned strength of judges is 7, but right now only 3 judges are left out in this particular appellate body. And of the 3 judges, 2 judges are going to retire by December of this year. The issue here is, whenever any of the case is appealed or any of the orders is appealed against in the appellate body, there is a requirement of 3 judges to take up this particular matter. And since the opposition of USA has continued to appoint these particular judges, the number of judges has now fallen from 7 judges to 3, which will further reduce to 1 by December 2019. And if only 1 judge is left out on the panel, then this particular panel becomes dysfunctional. Even if Government of India appeals against this particular order in the panel, the implementation of the panel recommendation, that is a dispute panel recommendation, will be held up. This is the discussion which has been provided in this particular article. Based on this, let's have a look at the question. Consider the following statements. India's per capita GNI is more than $1,900. Yes, as per the latest figures, it is more than $1,900. Second question. Article 3 of Agreement on Safeguards and Countervailing Measures regulates the export subsidies given by the member countries. Yes, even the second statement is true. Right option will be option C. Both are true. I've also given a descriptive question. Discuss the issue of export subsidies from Indian context. 250 words. Let's have a look at the next article, which is related to government finances. Some of the important points which are discussed in this particular article are: 1. The GST collection in the month of September has fallen down to 91,916 crore rupees. The concern is, this particular collection of GST revenues is the lowest in the last 19 months. First point. Second point. In the period when the GST revenues are declining like this, Government of India's direct tax revenues also will come down, because Government of India has cut down the corporate tax rates, as a result of which government exchequer will be collecting 1.45 lakh crore rupees less this year. Second, direct tax collection, especially the income tax collections, have not increased at a faster pace or expected pace, as a result of which the total direct tax collections of the government have come down or have been lesser than the estimated numbers. As a result of this, the indirect taxes plus direct tax collections has come down. The revenue mobilization is on a lower side. This is going to have a direct impact on the finances of the state government. Now, why this is very important? 2 facts are given here. 1. State government. The total expenditure incurred by the state government is 1.5 times more than the total expenditure incurred by the central government. I'll repeat the statement. First, the state government, the expenditure incurred by it is 1.5 times more than the total expenditure incurred by the central government. Second, of the total capital expenditure incurred by center plus states, 2/3 of the capital expenditure comes from the state governments itself. Now, the concern which has been raised in this article is, since the total revenue mobilization has come down, this is going to have a direct impact on the total expenditure done by the states as well as the capital expenditure done by the states. Already, as per RBI report, which has stated that the fiscal deficit target, although is 3%, and the states have fixed a target of 2.6% for this particular year. Last year also they had fixed a fiscal deficit target of 2.5%, ended up revising this to 2.9%. Why? For a simple reason, tax revenues became lesser and revenue expenditure overshot. As a result of this, the states were forced to revise their fiscal deficit target. First. Second, yes, on paper the fiscal deficit of the states although is less than 3%, but if you take into consideration the guarantees which are provided by the state governments in case of the PSE's borrowings. I'll repeat the statement. If you take into consideration the guarantees which are provided by the state governments in case of the PSE's borrowings, the total fiscal deficit of the states will be much larger or higher than 3%. That is the second point noted here. Third very important point, the debt at the national level. Now what do you mean by debt? The total borrowings or the total liability of the government. Let's be focused only on the state government here. The total debt or the total liability of the state governments at the national level is somewhere in the range of 25% of GDP. And as per encasing committee recommendation, this has to be dragged down to 20% by mid of the next decade. Now, in order to reduce this particular debt of the states to 20%, the total revenues will have to increase by 14% annually. Now, rather than experiencing an increase in the revenues of the state governments, right now we are seeing there's a decline in the revenues collected by the state government. That has been one more concern which has been raised in this particular article. So, these are some of the points which are mentioned in this. Based on this, let's have a look at a question here. Consider the following statements. The capital expenditure incurred by the states accounts for 2/3 of the general capital expenditure. Whenever they use the term general in case of the revenues, it means center plus states. And this particular statement is true. The debt to GDP ratio of the states stands at around 25%. It is also true. So right option will be option C. Both are true. The next article is related to role of RBI. Now we all know that there is a slowdown in the domestic market, and to reverse this particular slowdown and achieve higher GDP growth rate, both Government of India as well as the RBI are taking certain measures or steps. Let's be focused on the role of RBI here. RBI in this year alone has reduced the repo rate. It has reduced the repo rate 5 times, expecting that the banks will borrow more at lesser rate of interest and will also lend more at lesser rate of interest. And when more loans are issued in the market at lesser rate of interest, we expect more companies to take loans, investment in the market to increase, production in the market to increase, supply in the market to increase, employment in the market to increase, the demand in the market to increase, which in turn again will lead to what? Higher production in the market. So what we expect is a virtuous cycle of investment as well as consumption in the market. Hence, RBI says there will be a revival of demand, there will be a revival of growth in the domestic market. But various experts have stated that the role of RBI in reviving this kind of economic cycle is very limited. Their argument is very simple. Right now, the demand or the aggregate demand in the market is experiencing a slowdown. And RBI can do very little with respect to increasing the aggregate demand. The majority role in case of a reversing or increasing the aggregate demand will be played by Government of India. And the reforms which are taken by Government of India are not addressing the demand side, rather they are addressing the supply side. This is one point which is mentioned in the article. Second very important point mentioned is RBI, in order to ensure there is efficient monetary policy transmission, has asked the banks to start shifting to a new lending rate mechanism that is called as external benchmarking. Now what I am referring to here is RBI since February this year kept on reducing the lending rate. Between February to August, RBI reduced its repo rate by 110 basis points. And very recently it has reduced its repo rate by 25 basis points, thereby taking the total reduction in the repo rate to 135 basis points only in this year. But more importantly, though it reduced the lending rate by 110 basis points between February to August, banks collectively reduce their lending rates by 29 basis points, which in simple terms refers to inefficient monetary policy transmission. In order to have an efficient monetary policy transmission, RBI has asked banks to shift to a new external benchmarking lending rate, where a new mechanism or a methodology will be used to calculate the lending rates in case of some of the types of loans such as housing loans. So basically RBI, in order to ensure efficient monetary policy transmission, has asked the banks to shift to a new lending rate, but various experts have stated that there would be a very limited impact of this kind of an external benchmarking also. For a simple reason, earlier also RBI has used various tools or various types of lending rates in order to ensure efficient monetary policy transmission, but the banks have not been able to transfer the benefit completely to the borrowers in the market. One of the argument which is put forward by the banks always is, yes, RBI will lend us, but the lending from RBI under repo window is very limited. In simple terms, how much money I borrow from RBI under repo is only up to 1% of my NDTL, net demand and time liabilities. Whereas I borrow from multiple sources such as households, corporates, etc. On these particular deposits, I will continue to pay the same amount of a rate of interest. So when RBI asks me to shift to an external benchmarking, there is no guarantee in the market that there will be an efficient monetary policy transmission down the line. So this article concludes saying that there is a very limited role that RBI can play in the present context of reversing the economic slowdown. These are the points which are mentioned in this particular article. So these are the various articles as well as the questions related to these particular articles for this particular reference period. Thank you. Have a good day.